and welcome. Thank you for joining me today for our webinar on 2020 dates, deadlines, and contribution limits you need to know. I'm going to walk you through things that are just important for your retirement accounts and other types of accounts that we hold here at Advanta. And we have a few deadlines coming up that are going to be very important to you guys. So thank you for joining us again. My name is Larissa Green. I've been with Advanta IRA since 2011, and I've been teaching classes since probably 2012 or 2013. And I also do a lot of networking events as well. Prior to teaching classes and networking and sort of being a member of the business development team, I did a lot of the back office transactions, including things like making investments on clients' behalfs, paying bills for accounts, as well as receiving any income, depositing checks and coding. I also helped with transfers and things of that nature. So I've sort of done a little bit of everything in the business at one time. And now I teach classes sometimes on a weekly basis. So I would encourage you guys to join us for other classes, and I will give you more information on that at the end. A little bit about Advanta before we get started. We are a self-directed IRA administrator that we've been holding accounts that invest in alternatives for almost 20 years. And we have a couple of offices. We're here in the Tampa Bay area of Florida, and we're also in Atlanta, Georgia, but we can help people with accounts nationwide and even worldwide. So if you have a US-based retirement account and you want to invest outside of the market, we can help you with that. And something that we do that's a little bit different than our competitors is everybody that holds an account with Advanta does have a dedicated account manager to help them understand things like contribution limits, for example, as well as ways to make different investments, the rules for making investments in a self-directed account, and more. So if you have questions, or if you're a member of Advanta IRA already and you have questions, just let your dedicated account manager know, or you can always reach out to me, and my contact information will be available again at the end of the slide. I do want to let you guys know that I will take questions throughout the webinar and again at the end. So if you have questions, go ahead and type them into the chat box. I keep everybody muted just because we are recording this so that we can share it later on. And just to keep it nice and clean, we like to keep everyone muted, but get your questions typed into the chat box and I will take them as we go. A disclaimer for you guys, we don't give any tax, investment, or legal advice, and that's very important because we share information on the rules and, again, things like deadlines and contributions. But when it comes to things like, is this a good investment? Is this the return I should be getting? We can't give you that advice. So we would then encourage you to reach out to professionals that can help you with that. If you don't have a professional on your team that can answer those questions, let me know and I can probably refer you to somebody that has helped our clients in the past. I wanted to list up here for you guys the self-directed types of plans because I'm going to go over the contribution limits and deadlines for these plans today, and so you'll see it a little bit differently when I go to the table. But just to give you an idea, of course, we're going to talk about traditional and Roth IRAs, SEPs and Simples, or what they're considered sort of the employer-based IRA accounts. We'll also talk about solo 401ks and then health savings accounts and education savings accounts. And this slide really is talking about what can be self-directed. And so, of course, included there is going to be former employer plans. So anything from, an old 401k, 403b, 457 plan to a TSP or a pension, those can be self-directed and rolled into these types of accounts. So let's go on so we can dive right into plan contribution limits. So these limits are going to come with deadlines, and I will start with that information on the next slide. But here are the contribution limits. So traditional and Roth IRAs, and some of these change every year, and some of them change every few years, and sometimes they don't change at all. It just depends. And so as we go into the new year and you're looking at making your contribution, I'm sure we'll have another webinar and blog articles that will indicate what has changed and what has not changed. But for 2020, here are your contribution limits. So traditional and Roth IRA are going to be $6,000. It's $7,000 if you're over the age of 50. So that's considered the catch-up contribution. If you're over the age of 50, you can put $7,000 in instead. This amount is going to be total per individual. So what that means is, although you can have, a traditional IRA with a brokerage firm and a traditional IRA with Advanta IRA, your contribution limit of 6,000 or 7,000 over the age of 50 is going to be total. So if you make 2,000 with one account, you make 4,000 for the other, and you max out at 6,000, then that's going to be all you can make. It's not 6,000 in one account and 6,000 in another. So you do want to be aware of that because you don't want to end up with an excess contribution. So those are the limits for traditional and Roth. They do occasionally change. I haven't looked them up, to be honest, for 2021 yet, so I don't know what changes will be made. But again, I'm sure we'll have that in an upcoming webinar, and of course, we'll update that information on our website when we get into 2021. The SEP IRA contribution limit, and this is a plan for sole proprietors and independent business owners, and so it allows a larger contribution on an annual basis. It's up to $57,000. This $57,000 is based on a formula. So just sort of a side note, and very important for you guys, is that all of these contributions, with one exception, and I'll talk about that, are going to be based on earned income. So what that means is you have to have earned income in order to make the contribution up to the limit. You have to have the annual income up to that limit in order to make 100% of the contribution. So what that means to you is that even with a traditional or Roth IRA, you have to have had $6,000 in earnings to make that total contribution. And I know sometimes as investors, you may not have what the IRS considers earned income. So that's going to be very important for you guys, and something you want to work with your CPA on to make sure that you have the income to sort of back up the contribution, so to speak. So going back to the SEP IRA, it's going to be up to $57,000 or 20 to 25% of your earnings, basically. And depending on how you have your business set up, it's your salary, or if you're a sole proprietor. I mean, it just depends on how you're set up. But it's 20 to 25% of your earnings, meaning that if you earned 100,000 this year, let's say you paid yourself a salary of 100,000, then it's going to be 20 to 25% of that amount. And the difference is going to be dependent upon how you file. So for example, a sole proprietor could potentially contribute 20% of their earnings, while somebody with a formally established entity might be able to put 25% of their earnings into the SEP IRA. With a simple IRA, and not to exceed 57,000. So, you might earn $1 million this year, and your limit is still going to be 57,000. So that's important, again, to note with the SEP IRA. With the simple IRA for 2020, you can put $13,500, and that's an employee contribution. There are two types of contributions with the simple IRA. You're both your employee and your own employer. And so you're really technically making both contributions, but depending upon if it's you making the contribution versus your business, that's going to depend on where the funds come from. But essentially, as the employee, you can put $13,500 in. You can put another $3,000 if you're over the age of 50. Again, that catch-up match. And then on top of that, you can do a match from the employer, and it's 1 to 3%. So that's just important for you guys to understand. Is it depends on how you set up the plan initially as to how the contribution by the employer is made. One versus the other might be advantageous to you depending on whether or not you have employees. A simple plan does allow you to have employees as well as a SEP plan. So again, it just really depends on how you're setting up the plan initially as to what kind of match you're doing as the employer. The next plan I have listed here on the table is a 401k. And of course, we talk very specifically about a solo 401k, but the contribution limits are there for you. The 401k employee contribution, and again, just like with this simple, there's two types of contributions being made here. Both the employer and the employee are going to be making contributions. It's $19,500 for the employee. And then if you're over the age of 50, you get a catch up of another $6,500. And then the employer can make a contribution. And I don't like to call it a match, really, because it's just an employer contribution. When we say employer match, people think it has to be, 4% or 6% of the earnings, and it's just a contribution. So it's 20 to 25%, and similarly to the SEP IRA, it's going to be dependent on how you file. So again, a sole proprietor versus somebody with a formally established entity, and also how you're paying yourself. But another 20 to 25% of those earnings. So just a quick example, if I earned 100,000 this year and I made the employee contribution of 19,500, and I could put another 20% in as my own employer, then I would be able to put 20,000 in, and so my total contribution would be 39,500 in my example. This combined total cannot exceed 57,000 for 2020, or 63.5 if you're over the age of 50. So I hope that helps you guys understand how those contributions are made. The next one on the list here is the ESA, or Education Savings Account. It's also known as a Coverdell. It's also known as a CISA, so there's a couple different names for it. And the contribution limit is $2,000 per child per year. That has not changed for as long as I can remember. We don't see a whole lot of ESAs. I think maybe because the contribution limit is lower. I'm not really sure, but you can certainly self-direct it. And so, we hold these types of accounts. They do have benefits. They sort of grow like a Roth account, meaning that it's going to be tax-free as long as distributions are for qualified education expenses. So it can be very beneficial. It does have a lower contribution limit, and I won't go too much into that today, but if you have questions on those accounts, let me know. The last account here on the slide is going to be the HSA, and the contribution limit is listed there for you. It's $3,550 for the individual. So if you have individual coverage and your healthcare plan allows contributions to HSA, so that's very important. The plan must allow the contribution. Then as an individual, you can put in $3,550 with a $1,000 catch up if you're over the age of 50. And then the family plan is $7,100. And again, if you have family coverage and your plan allows contributions to HSAs, you can put $7,100 in for 2020. So let's talk about the different types of accounts and their deadlines, because we're coming up on some deadlines that you guys would want to know about, and they're coming up kind of quickly. So for the first example here, we have traditional and Roth IRAs, and we have plenty of time really to make those contributions. But I would urge you guys, if you're considering making your contributions, or if you definitely plan to do it sooner rather than later, because there's some things to be aware of when you're making your contribution. So again, there's a contribution limit for you, and the deadline, April 15th, 2021, and that's as of right now. So we sort of had a whole lot of unexpected things happen for 2020. And as many of you will recall, we had the deadline extended by the IRS this past year. I don't anticipate that at this time. So as of right now, it's April 15th, 2021. Traditional and Roth IRAs can be open and funded all the way up until this deadline for the previous year to make a contribution. So, for example, if I did not make my 2020 contribution and it is April 15th, 2021, I can still open that account and fund it, so that you guys have the ability to get possibly a deduction on your taxes, get that contribution in there to start your Roth clock ticking. So there's a lot of reasons that you would want to make a previous year contribution into the following year. So the traditional and Roth IRAs will allow you to do that. Part of the reason I mentioned that you would want to make your contributions sooner rather than later is that you want to make sure that you don't miss this deadline, and it is very easily missed. April is a very busy month for us because a lot of people are trying to get their contributions in. And so first of all, if you're opening a new account, we have to have your application in our office by April 15th at midnight, or postmarked by April 15th. And that also includes making the contribution. So whether you're doing an ACH, a wire, or you're mailing us a paper check, we must have everything in the office that we need by midnight on April 15th in order to honor it for the previous year. So there are no exceptions for bounce checks, checks lost in the mail, wires not received, ACHs that were delayed, whatever it might be. There's no exceptions for that. So just make sure that if you're considering making a 2020 contribution, you look at the timeline, set a reminder on your calendar, and give yourself plenty of time, because these things do unfortunately happen, and we want to help you the best way that we can. So the next one that we're going to talk about is a SEP IRA. And again, there's your contribution limits and the deadlines are included here. So a SEP contribution is really made by you as the employer or by your business. And so what that means is that you're making the contribution up until the filing deadline for the business plus extensions. And so that really gives you a lot of time to make a previous year contribution. Why is that important? Well, that deadline could technically be as late as October 15th, 2020. So if you are an independent business owner, a sole proprietor, you can still make that contribution for 2019 if you haven't filed. So that's important. If you have not filed, you would still have the ability to make that contribution and you can open the account. So the SEP IRA is interesting in that way. So if you are still looking for a deduction for your business, if you are still hoping to make a contribution and get more money into retirement, a SEP might be the way to do it. Of course, check in with your CPA, make sure that this is the right kind of account for you and that you didn't do your business filing so that you can still open and fund that account. And again, it could be as late as October 15th, 2020 for your 2019 contribution. I did see a bunch of questions asking for the slides, and I apologize. I normally post them as a handout, and I did not this time, but you certainly can reach out to me, and I will email them to you. So my contact information will be at the in the end of the webinar again. Just send me a quick email, and I'll send out the slides to you so that you'll have them for your review. Thanks, guys. So that's the great thing about a SEP IRA. So you still have a little bit of time there. And if you haven't done your filing, check with your CPA and then reach out to us so we can help you get that account open and funded prior to your filing deadline. An interesting note about a SEP as well is that because it's the employer contribution, that means that you would still be eligible to also make a traditional or Roth contribution if you chose to do so. So a great way to put more money into a retirement account. The next one we're going to talk about here is that you have, is the simple IRA. So again, the contribution limits listed for you there. And then let's talk deadlines. So the employee contributions, they should really be made by the final paycheck to the employee. So typically into January, maybe the following week or a little bit beyond, but you are allowed technically to make it into the end of January. So January 31st is going to be your employee contribution deadline in the simple IRA because you're self-employed and maybe you don't take a regular paycheck or maybe you handle it a little bit differently. So check with your CPA, but technically up until January 31st, 2021 for your 2020 contributions. You also have your employer contribution. Remember that 1 to 3%, depending on what you elect when you form the plan, is going to be your tax filing deadline for the employer plus extension. So again, as late as October 15th, 2020 for the previous year. And again, talking 2020 contribution deadlines, you're going to have all the way up until October 15th of 2021 to make your 2020 contribution. But just so you guys are aware, if you have a simple IRA, so your plan does have to already exist for a simple. It's different than the SEP where you can still set it up and still fund it. The simple IRA already has to exist. As a matter of fact, today would be the deadline for creating a simple IRA to be active for the current year. So October 1st, you have to have your simple set up and then you would be able to make 2020 contributions. There are a few exceptions to that date. I'm not really going to go into that. If you have questions on it, you can let me know. But this plan could still be established as of today. If you have a simple plan existing, you have until January 31st, 2021 for the employee contribution, so that $13,500 plus another $3,000 if you're over the age of 50, and then up until October 15th of really 2021 for the employer match for your 2020 contributions. These plans are often used for small businesses. They're great for that because the employees can put a little more in, and they tend to be inexpensive to maintain. So that's a benefit to the simples, maybe over other types of retirement accounts. So now let's talk about the 401k, and it's going to have very similar contribution limits to some of the other plans, and also the rules are going to be similar to some of the other plans, but it really sort of does stand apart because of the way you can contribute and the way the plan is set up. So 401k, again, we talk mostly about solo 401ks. That's what we can help you with at Advanta IRA. And so if you're a sole proprietor or an independent business owner and you have no employees, you can have a solo 401k. It's a great account. It allows for a few different types of contributions on an annual basis. So being familiar with those types of contributions can be a huge advantage to you if you're really trying to save on taxes and maybe possibly have some money grow tax deferred and some grow tax free as well. So there's a few different ways you can make those contributions. And I'll talk about that very briefly, but I did do a webinar on solo 401ks last week or the week before. And so that recording is on our YouTube channel if you guys want to go back and listen to it. But it is a great topic. It's a great account if you're a sole proprietor or independent business owner. The next, and I did have a question pop up here. In general, does filing a return cut off the contribution? It does. Yes. Yep. Thank you for that question. I do want to clarify. So even though you have the ability to make the contributions if you've already filed, so, you know, for example, we say as late as October 15th, 2020 for certain employer contributions. If you've already filed, that is going to cut off the contribution date for you. So yes, absolutely. Thank you. So with the solo 401k, again, here's the contribution limits, and we talked a little bit about how that works. Your contribution deadlines are going to be, again, very similar to the simple because of the employer-employee contributions. As the employee, and again, you're wearing two hats in these scenarios, you can contribute into January of the following year for the previous year. So again, January 31st is really going to be your cutoff. If you're paying yourself a salary, it should really, your final contribution should be in the final paycheck for the year. There's some leeway there as a sole proprietor and independent business owner with no employees, so you have a little bit of time in there, but make sure your contribution is made into January. There's going to be some exceptions there. So you might want to check with your accountant. You may be able to make the contribution for employee after that. And we're not really going to help you with that. If there's some exception, it's going to be up to you to check with your CPA on those. So employer contributions, again, are going to be filing deadline plus extensions as late as October 15th. And then this would be for the previous year contribution as late as October 15th, 2020. If you're talking about a 2020 contribution, it could be all the way as late as October 15th, 2021. So you would still have some time. The 401k has to have been established. And so this is where the rules sort of come in, and the rules have changed a little bit. For 2019 and into 2020, you had to have had your plan established by December 31st in order to make contributions for 2019. So if you're still looking to make 2019 contributions, you have up until October 15th, 2020. The new rule is that you can establish the plan after December 31st for the previous year, but if it's beyond the time that you should have made the employee contribution, you are no longer eligible to make that contribution. So it changed for, as of 2020, used to be December 31st was the cutoff. The new cutoff, there really isn't one, but you may miss the ability to make an employee contribution depending on when you establish that plan. Now, the employer contribution, again, is going to be up until your filing deadline plus extensions, if you file for extensions, and then October 15th, 2020, which is right around the corner for previous year contributions. So if you haven't made that contribution, you still have a little bit of time to do that. I had another question pop up. Give me just a second to review it. Can I contribute to a previous employer's 401k? Unfortunately, they're not going to allow you to do that. Once you've severed ties and you're no longer technically participating in the plan, they're typically going to want you to roll that into another employer plan where then, of course, you could make the 401k contributions, or maybe to a solo 401k so that you can make those contributions, or into a traditional IRA. So I hope that's helpful to you. I had one more question pop up here. question is asking about how the contribution shows up on your tax filing, and I am really not familiar with that, so I would encourage you to check in with your CPA, or I may just be misreading your question, so I'm not sure. But how the contribution shows up on your tax filing, I think it's going to also depend on how you file, but just check in with your CPA on that. Okay, so with the solo 401k, again, I mentioned your deadlines there. Remember that you're making both employer and employee contributions because you're wearing two hats. So even if you don't have a formally established entity, you can still make these contributions as a sole proprietor. Contributions made by the employee can be pre-tax, so like a traditional IRA, they can be Roth, or they can even be after tax, depending on what your plan allows. So again, making sure your plan allows all of these options and then taking advantage the best way and the way that makes the most sense for you. And then the really important part here as well is that the employer contributions are always pre-tax. And I always like to mention that because a lot of times people say, well, I want the Roth 401k. That's the type of account I want to have. But employer contributions, um, the 20 to 25%, that's always going to be considered pre-tax. Your plan may allow you to roll that into the Roth component of the 401k, but then at that time it would be a taxable event. So just, again, checking with your CPA, making sure you're doing what makes the most sense for you at that time. But the employer contribution is always made pre-tax. So next, we're talking here about, I had one more note I wanted to make on the 401k. So as of 2020, I already mentioned that the 401ks can be established until the employer's tax filing deadline plus extensions, and the employer will be able to make the contribution up until that date. And again, if it's past or beyond the time when the employee can contribute, then you're going to have to forego the employee contribution for the year. But of course, there's a huge advantage to being able to still make the employer contribution based on your earnings for that year. Next, we have the education savings account. I mentioned it's also called a Coverdell, and sometimes also a CISA. Those can be opened and funded up until the filing deadline of April 15th for 2021. So if you're considering a CISA and we get into 2021, you have up until April 15th to open and contribute for 2020. So again, $2,000 per year per child. You can literally open that account, make the contribution all on April 15th, and as long as we have everything that we need in order to establish that account, we can credit you with a 2020 contribution. So all the way up until April 15th, 2021. And again, I would encourage you guys, if you're considering this, to put it on your calendar as a reminder, because anything lost in the mail, anything not received by midnight on April 15th, 2021, unfortunately, there's just no way to make that up. So it's very important. Next here on the list, I have health savings accounts, and I mentioned there's the contribution limits again for you guys, and the date to open and contribute to this plan is going to be April 15th, 2021, but there are some rules that go along with a health savings account. It is a great account. There's a lot of advantages to it, and this is going to be the only account that we have talked about where you can make contributions on earnings on income that isn't considered earned that you're paying self-employment taxes on. So this is going to be the only one. If you have investment income or other types of income that you're not paying self-employment taxes on, you can still make a contribution to an HSA. This is the only account with that exception. The contributions are possibly tax deductible, they grow tax deferred, and they are tax-free on distribution for qualified medical expenses. We have a whole webinar on health savings accounts. I would encourage you guys to check out that webinar. My partner Alex will be doing a refreshed version of it coming up in the next couple of weeks. But if you go to our YouTube channel, you'll also find the recordings that he did earlier this year and last year on the HSA. Again, it's a great account. You should definitely learn about it if you think you're eligible. It is not a way to self-insure, so that's very important. You have to have healthcare coverage, and your plan has to allow contributions to an HSA. So when somebody calls me and says, well, can I have an HSA? I say, well, reach out to your provider and make sure that your plan allows those contributions. So that's going to be your first step. You want to do that. Once you find out if you have a high deductible healthcare plan and it allows those contributions, then you can certainly open and fund the account. The way the rule works for an HSA is that you must have qualifying coverage as of December 1st, 2020, in order to make a contribution and maintain that contribution. You must also maintain that plan for the following 12 months. So if you have qualifying health care coverage on December 1st, 2020, and you're going to maintain it for the following 12 months, then you can make the entire contribution to the HSA. Again, that's just very important for you guys to understand, because I think a lot of times people think, well, if I have the HSA, then I don't need health coverage, or I can get a minimal plan. And you do have to make sure the plan allows those contributions. You want to make sure that you have it as of December 1st. And as long as that's true and you're maintaining that plan for the following 12 months, then you can open and fund an HSA all the way up until April 15th, 2021. So again, application, contribution to our office by April 15th, 2021, and we can open and fund that account with a 2020 contribution, so previous year contribution. I had some questions pop up. Give me just a second to review them, and then we'll go on to the Roth conversion deadline and how it works. Another question about the slides. Yes, I'm sorry. I usually do include them as a handout. I did not. Just reach out to me, send me a quick email. I'll reply and make sure that you get the slides if you want them. Also, this is being recorded, so you'll have the opportunity to review it again if you would like. You'll get the recording sent to you in an email in just a day or two. So it just takes a day or two for my marketing team to get it all put together and send out the link. So you'll receive that as well. Just make sure that you send me an email. I'll give it to you now, and then it'll also be at the end of the presentation, but it's lgreen with an E on the end at advantaira.com. Again, lgreen with an E on the end at advantaira.com. So we're going to go on here to Roth contributions and excuse me, Roth conversions. And with Roth conversions, it's important to note that the deadline for your Roth conversions is December 31st of this year if you want it to be an event, a taxable event for 2020. I think with all of these other deadlines going into the following year, a lot of times people get confused and they're thinking, okay, well, I have plenty of time to do a Roth conversion if I decide to do it because I have until April 15th of the following year. And that's really just not the case. So it has to be done by December 31st. And also, there was a time when you could do a Roth conversion and then you could undo it essentially. But they have changed that, they have ended that. So you can no longer undo the Roth conversion. So once you've done a Roth conversion, it is done. And so what you want to be aware of is that the amount you convert is taxable the year you convert it. It's taxable to you and not a burden to the IRA. So a lot of times people think, well, the IRA will just, I'll just make sure that I have enough in the IRA to pay those taxes. And unfortunately, it's 1099 income to you that year. So for example, if I convert $100,000 from my IRA to my Roth IRA this year, then I'm going to receive a 1099 as income to me for 2020. And so maybe this is the year to convert. Am I going to offset losses, or maybe this will be my lowest earning year of the years going forward, or whatever it might be, whatever the reason might be. I want to make sure that I understand I do it before December 31st, and that it's income to me the year I do the conversion in the amount I convert. You can also convert over time. So if you look at the amount you have in a pre-tax account and decide, you know what, I do not want to take that all in one lump sum as earnings this year, but I want to eventually get it to the Roth, how does that work? Well, you can do a little bit at a time. So if you convert 20,000 this year, 20,000 the next year, for as many years as it takes for you to get 100% of those funds into the Roth. But the good news is it's not an all or nothing strategy. So if you decide this one investment coming up is going to be the one investment that I want in a Roth IRA, you can convert the amount you need and you never have to convert anymore. But with every conversion you do in the Roth IRA, it has its own 5-year aging. So some of you that have a Roth IRA may already be familiar with this, but a Roth IRA has to age for 5 years, and you must be 59 and a half in order for it to be tax-free. So if I'm 37, so if I open a Roth IRA today and make a contribution, then by the time I'm age 59 and a half, it will have aged for well over 5 years, and those distributions will be tax-free to me because it's aged and I'm 59 and a half. If I'm 58 and I open a Roth IRA, then I will have to wait for 5 years. So until I'm age 63, and also depends on how the contribution is made, but age 63 in this example, until it would be tax-free. Every time you do a Roth conversion, it has its own 5-year clock. So if I already have a Roth IRA existing and it has 100,000 in it and I convert 20,000 more into that account, that 20,000 has to age for 5 years before it would be considered tax-free, as long as I'm age 59 and a half. So just a few key points there for you on Roth conversions, along with that deadline that is coming up pretty quickly. Keep that in mind, because especially as we get into the holidays, and you guys all know, it just gets to be a busy time of the year. And I know we won't all be traveling like we normally would, but we'll still probably have a lot of things going on our calendars. So make sure that if you're thinking about doing this, you decide rather than later. Get that appointment with your CPA to determine whether or not this is the time to do that. I did have a question pop up. When's a good time? It's really a personal decision, and sort of based on the information I've given you, you might want to speak with a CPA and see if now is a good time. We're seeing a little more Roth conversions early on than we normally would. I think maybe because people have um, suffered some losses this year, and so they figure maybe this is the year to do it. But again, we really can't give you advice on that, although we do have a Roth conversion webinar coming up. I don't really know the date on that at this moment, but again, advantaira.com/events for the calendar, and you can check that out, and we'll go into some more of the factors that will help you determine whether or not you should make, help you make that decision, basically. So based on your age, the amount of money that you have now, where you first in the sort of um, you know, taxes, where are you now versus where you'll be when you retire, things of that nature. I had a question pop up on it. It sounds like a traditional IRA is better for somebody over 59 and a half, since there's no 5-year aging. I think it depends. That could be a very good point. But as I mentioned, sometimes people see an investment opportunity that they would like to have grow tax-free, and they may have that investment opportunity with a term of 8 years, let's say. And so by the time that investment is liquid again, they'll have passed that 5-year. And so it really just depends on what it is that you're working on, maybe your age, maybe your tax brackets. Um, there's a couple of things that come into it. So if you have more questions on it, I would definitely encourage you to visit us for the Roth conversions webinar that we have coming up. I had a question pop up. Can you transfer an asset directly to a 401k? I think I need some more specifics on your question, but so I'll answer it, and if I don't answer it, let me know. But if you have a personal asset, it cannot be contributed, so to speak, to the 401k. That would be considered self-dealing, so you want to be careful with that. But if your traditional IRA, for example, has an asset, you can transfer that into a 401k, because that's a pre-tax account. It can go into a 401k, so as long as the 401k accepts those assets, that can be done. But something you own personally or owned by a disqualified person or entity, that would not be allowed into the 401k. So you want to make sure that you understand the rules on those. And again, we have webinars on those all the time. So definitely check that out and let me know if that didn't answer your question. So the last deadline we're going to talk about today is on the CARES Act distribution. So again, we've all had an interesting year so far, I would say, and we're all sort of moving around in this space, trying to get on our feet and figuring out what did the year look like behind us, and what it's going to look like ahead of us. And so of course we had the CARES Act that helped many people along the way. So distributions for the CARES Act, if you guys were not aware, the CARES Act did allow IRA and 401k distributions. So there's a couple of things to qualify, and we'll talk about that in just a second. Currently, you can take COVID-related distributions up until the end of this year. So December 31st is the current deadline. And I I want to stress current because, like I said, we just don't know what's going to happen going forward. And the CARES Act is evolving. It's changing very regularly. You know, when they first put it out, we didn't have a whole lot of guidelines as to what it is that these distributions would entail and how we would handle them tax-wise and what to do going forward and how do you get them paid back. And then, of course, we got some information on that and we were told more specifics. And so we just don't know what's going to happen going forward. And so, you know, if we have another unfortunate beginning of the year with COVID, they may make changes to this. So just keep you know that in mind when you're looking at this deadline. So December 31st is currently the deadline to distribute under the CARES Act for COVID related distributions. The distribution is penalty free. So typically if you're under the age of 59 and a half and you take a distribution, you're going to have a 10% penalty, and that's across all accounts. And then normally it would be taxable as income to you if it's a pre-tax account. So what they've done is they've waived the penalty, and you have a few options on the taxes. It's sort of treated as a rollover where you have 3 years to pay that money back. And you can either pay the taxes all in the first year, or you can pay it over 3 years and then amend your tax return. So again, a couple of things that go into this: check with your CPA if you're considering doing it, but you get that tax deferred or tax-free and penalty-free distribution if you need it up to 100,000. And again, you can pay taxes due over 3 years, and then amend your returns if you pay the money back. Again, it's sort of treated as a rollover. And to qualify, your spouse, or a dependent diagnosed with COVID-19 experience adverse financial consequences due to being laid off, furloughed, quarantined, or had hours reduced. We do not qualify you. So if this is something you're thinking about doing, again, check in with your CPA, make sure your CPA can help you understand the consequences and what's required of you and how to amend your tax returns and what that will look like going forward. Again, these are the current deadlines. The CARES Act, ever evolving, ever changing. They may extend it, I don't know, but at this time it's December 31st for those distributions. Here's my contact information. Again, I know a bunch of you asked me for the slides. My email is on there. Please just send me a quick email and I will send you the slides so that you have them for your review. This recording will also be shared with you via email. So anybody that registered always gets our recorded webinars so that they can review them. So that will go out in a day or two tops. Marketing is very quick usually to get those rendered. I don't see any other questions in there. I'm going to give you guys a few minutes to just put any questions in if you have them, and just mention our networking event. We have networking events all the time. They're every other Friday and they are done by Zoom. So it's a Zoom call. Everybody is welcome to introduce themselves. It's a haves and wants style meeting. And so if you're not familiar with that type of meeting, it basically means that everybody has the opportunity to pitch an investment they have, or talk about something they'd like to sell or something they're looking for. If you provide services, you're welcome to talk about those services and do a commercial, so to speak. And then we usually throw out a topic for discussion to engage everybody during these meetings. They're every other Friday. The next one is October 9th, so we hope you will join us for that. You can find it on our website at advantaira.com/events. It's Pitch, Promote, Prosper is the name of the event. You'll see it on there. I hope you guys will join us. It's a lot of fun. They've been very successful. We have 60 to 100 people on, and we've just really enjoyed doing it. So check that out. I had one final question pop up about a business owner and lost revenue for the CARES Act, and I'm really not the person to ask for that. So you would want to check with your CPA on that and see how that will work. Again, we don't qualify, so we've just been given sort of the this is what it would take to qualify. But if a client calls us and says, I'd like to take a distribution, then we just let them know this is what it would take for you to qualify. Talk to your CPA, tell us where to send the distribution. So it's going to be up to you. And so I really just don't have that information for you, but check in with the CPA who can definitely help you with that. Thank you guys so much for attending this webinar. I hope you found the information useful. Again, the recording will be posted and it will also be sent to you. I believe we will also have some of these deadlines posted on our website for you as well. If you guys have any questions, again, you can reach out to me directly. I hope you enjoy the rest of your day.